I'm Jennifer Wahab, Chair of HAR for 2022. I want to welcome you to this month's Global Interview Series. Every month, leaders from HAR's International Advisory Group will share their unique international real estate perspective and expertise with HAR members. I hope you enjoy this month's Global Interview.
Well, I'm an international tax attorney, which means that my primary role in this context is try to keep the agent's clients and the agents themselves out of trouble with the tax man. Now, the taxes we're talking about are federal taxes, income tax and the estate tax, and the estate tax is often overlooked, which we'll probably get into a little bit later. We're not talking about property taxes. Property taxes are imposed regardless of nationality or residence, but the income tax and the estate tax, the federal taxes, they are imposed based on tax residency, which is a very important technical factor to look at. And there are some serious tax traps, which we may be getting into too, for those who aren't aware that these rules exist, not only for the clients of the agents themselves, but for the agents also. Well, the main advice I would give is one, be aware that these special tax rules apply. At least become familiar. Now, you're not going to become a tax attorney, but you should be at least aware of the basics of these rules. And so that when you're advising your clients, when you get a new client, new real estate potential purchaser, just to be aware that these special tax rules apply. And especially if your common sense tells you that the client may be a foreign person. Now, what is a foreign person is a very technical issue, but generally it means a person who is not a U.S. citizen and who does not reside in the United States. But know that these special rules apply, and to advise the client that they should educate themselves on these, whether it's by Googling or by talking to someone like me. Educate themselves on this before they take any significant action with respect to U.S. real estate. Again, the agent themselves are not expected to be experts, but they should at least advise the clients to be aware that these rules exist and to educate themselves. FIRPTA. FIRPTA is an acronym, of course. It's short for Foreign Investment in Real Property Tax Act of 1980. Congress passed this rule back in 1980 when essentially they were afraid that foreign persons, especially the Japanese, were buying up all the U.S. real estate, like Rockefeller Center and Pebbles Beach golf course. And basically what the rule, it's an income tax rule. Really, two basic parts of FIRPTA. One is it emphasizes or clarifies that foreign persons are taxable on their gains on the sale of U.S. real estate. Because you say, well, isn't that obvious? Well, not really, because foreign persons generally are not taxable on their capital gains. They can buy and sell stock on the stock exchanges all day long without being taxed. But when it comes to U.S. real estate, they got to be taxed on it. They got to file an income tax return and pay tax on it. That's number one. The second aspect is the withholding mechanism, sometimes called the withholding tax. Generally, when a foreign person sells U.S. real estate, the buyer has to withhold 15% of the gross price, usually the gross sales price, and that's like a security deposit. It's not the final amount of tax, but the buyer is supposed to remit that 15% to the U.S. Treasury as security for the foreign seller to file a U.S. income tax return, determine what his gain is, determine the tax on that gain, and to pay it. If the actual tax is less than the withholding, then they get a refund. It may take a long time to get the refund, but the refund is going to eventually come. So those are the two main elements of FIRPTA. Now, there are other income tax rules and estate tax rules that deal specifically with foreign persons. For example, there's a withholding tax on rental income, which is often overlooked, but that's an important part. We sometimes refer to FIRPTA as including these rules, although they're not technically a part of FIRPTA, but really any of the special tax laws that apply to foreign persons is sometimes generally referred to as the FIRPTA rules. Well, there are two basic sets of rules to be concerned about. One is the income tax, and now I've been discussing what is FIRPTA and so forth. The basic rule is that when a foreign person sells U.S. real estate, and that might also include an interest in an entity like a corporation or an LLC or a partnership that owns real estate in turn, the sale of these interests are subject to capital gains tax. There's no exception for foreign persons. And there's this withholding mechanism that I mentioned. That only applies if you're a foreign seller, not a U.S. seller. So that's the basic rules for the income tax. That, and also that rental income is subject to taxation, generally with a withholding tax, 30% withholding tax. And so you have that withholding obligation. So that's the basic rule of the income tax. Now the estate tax, which is often overlooked, is that if a foreign person dies holding U.S. real estate directly in his own name or through a partnership, an LLC, 40% of the value of that has to be paid to the U.S. Treasury as an estate tax. And that is often overlooked. But those are the two basic rules you got to be concerned about, the income tax and the estate tax. Well, there's basically two or three. The first one by far is the estate tax trap. People, foreign purchasers of a condo or a house here, just for vacation use or for investment, do not realize that upon their death, if they get hit by a bus before they sell it, then their family has to deal not only with the loss of that family member, but also with a 40% tax, and they can't sell the property or dispose of it until they get a certificate from the IRS saying that the tax has been paid. And another thing that makes them distraught is when they realize that that tax could fairly easily have been avoided with just a little bit of basic structuring, such as holding the real estate through a foreign corporation or through an irrevocable trust. So it could be avoided. So that's the biggest tax trap. The second tax trap is the failure to withhold on rental payments on property that's owned by a foreign person. A typical residential renter doesn't even know, has no idea what these rules are. And so who is the IRS going to come chasing after if the withholding tax is not withheld and paid, and if the foreign owner of the house has not paid the tax? They're going to be looking at someone else, like a property manager. And here it's an obligation and a risk not only to the foreign owner, but to the U.S. agent who represents that owner. So that's the second one, the failure to withhold on rental payments. There's some others here and there. For example, if the agent represents a client who sells stock in a corporation that owns real estate, they often don't realize that FIRPTA withholding obligation applies to the sale of that stock as well as to a direct sale of real estate. So that's another dangerous tax trap. So those are the three main ones I see. And it just, again, I don't expect an agent to be expert on this, but they should be sufficiently aware that these risks are out there so they can advise their clients to go get some assistance. And also when it comes to withholding, they need to know what their own rules and obligations are as well.
Thank you for watching this month's global interview. I hope you learned something new that will help you in your international business. Do not forget to sign up to receive our global newsletter as well. It's a wonderful tool. Thank you so much and see you soon.